Welcome. A busy week for energy markets, to say the least. You had OPEC plus, you've got a dollar which is weakening, inventories on our radar, elections. I want to begin with the OPEC meeting, though, and the decision, because everybody's talking about how the Saudis are cutting production and how that's supporting prices, but the Russians are increasing production. So it's basically a wash. Am I correct?
I don't think it's a total wash. I mean, you're seeing Saudi Arabia voluntarily cut production by about 1 million barrels per day. From my understanding, you're only seeing an increase of probably across OPEC plus between Russia and a couple other small ones that maybe a total of 150,000, 250,000 barrels per day. But remember, Libya's production was also coming back online. Yeah. So I think there's a number of balls in the air that are a little uncertainty, but I think the powerful move through $50 that we've seen is just more on the coordination within OPEC plus. I mean, they've done a terrific job, and I've come on the show many times over the last year and said how well of a job since March that they've done and really getting this market bottom out and coordinating, and that alone is what's driving things for right now. But people are looking farther out. The same way people extrapolate out in the stock market where earnings are going to be 6 months and a year from now, they feel confident that OPEC plus is going to continue to do what's needed.
You know, Bill, you bring up a good point there, and I'm glad you reminded us of the fact that it's been a contentious, or was a contentious year for the member nations of OPEC Plus, as they were butting heads quite a bit. I mean, we even saw that this week, one could argue, where they were supposed to announce on Monday. It took till Tuesday before we actually got the announcement. I guess the question here I wanted to ask you is, are they comfortable with prices at $50?
I think 50 to 55 is definitely an area that they're comfortable with, and Brent is pushing that upper band right now. So this is OPEC, don't get me wrong, but I think there's two other narratives here that are really very powerful right now, and that's continued buying from China, or really three narratives: China, the U.S. dollar weakness, and then looking at the data yesterday across the EIA. Big draw in the headline, but obviously there were builds in the products. But you're seeing strong refinery runs, utilization that week over week. This number yesterday, and then the one for the prior week, for the week before that. Increases of nearly 1.5% refinery utilization. And this is something we talked about in December after we got that surprise 15 million barrel build in December. We were writing in our research that we expect this thing to get drawn down over the next month. And that's exactly what we've seen. And that's been a tailwind here. But let's not forget that China is been a huge buyer throughout the last year, has continued to be such. And the weaker U.S. dollar allows China to buy more crude oil.
All right, I'd imagine you could attribute some of this bid activity to stimulus measures as well, expectations that the two Senate seats that I was just talking about, that the Democrats secured in the Georgia election, Senate runoff elections. I mean, again, in theory, that's going to help the Biden administration kind of effort some of their agenda, and in theory, support crude prices as well, one would argue.
Absolutely, and that's another factor. There's a lot of tailwinds here, actually, now that we discuss about it. I think you're seeing the broader risk environment, more stimulus. It just helps stave off deflationary fears of new restrictions and lockdowns that are occurring, obviously happening in Europe. What could happen here in the United States as the COVID-19 pandemic continues on? Again, that's a deflationary measure, really, that as this thing continues. But you get more stimulus, and that inflation is actually really, we believe, is going to really start to show up here maybe after the end of Q1. Maybe it's a little closer to the end of Q2. But I think that's going to be a tailwind for commodities. We do think the U.S. dollar is going to continue to be weaker because of that stimulus. It may be a little overdone to the downside right now. So we are cautious of where the U.S. dollar is. But we do think that trend continues. When currencies really begin to trend, they trend for really years. It's a multi-year trend. So I think that could be something that we're just starting to see in the dollar, and that's going to be a tailwind for commodities.
All right, last thought in terms of energies before we move on to a couple other commodities I want to cover with you. I've been keeping an eye on the gasoline futures contract. You know, this EIA report provides many components to it, and there's a lot of different lines to look at here. I did notice this week that inventories in terms of gasoline were up a little bit, production was down, but one thing that I've been seeing for the most part is production has been up and inventories have been down. How closely do you look at RBOB gasoline futures? Here you can see inventories up 4.5 million barrels, but how closely do you watch that relationship to crude?
I watch it very closely. This time of year, it's not on I guess the top of my radar.
Okay.
But it starts to become such through the middle of December. I'm sorry, the middle of January, and really, I look to get long exposure in gasoline through the middle of January, sometime between then and the end of February. And that's really where the seasonality starts to kick in, where I don't know when that right time is going to be. No one's going to be able to time it every year at that proper time. But I believe if you buy gasoline sometime between the middle of January and the end of February, and you look to hold it into Memorial Weekend, you're going to make money. And that's one of the positions that we're starting to get on our radar right now.
Yeah, I like the mention of the seasonality associated with these products as well. And then ultimately, Bill, that would feed right into the narrative in terms of the vaccines and things heating up this summer, people wanting to get back out. And if they're feeling secure, I'd imagine that that's something that's going to be on the minds of everybody, and actions will be taken in those in the direction of. Let's talk a little bit about some of the metals, the products. I want to begin with copper because it seems to be, in all fairness, the one that should probably be addressed first. Gold's been not really providing directional conviction one way or the other, but copper feeds right into the narrative in terms of what we're just talking about as far as what's behind the bid in energy markets, whether you're talking China demand, a weak dollar, or just expectations for more stimulus, and in this case, maybe some infrastructure.
Infrastructure, absolutely, and that's infrastructure is something that we focused on the portfolio management side too, and definitely getting exposure there. But copper, 360 was my target, and on really the onset of Q4, and we got there in a hurry. And I've been on the show before talking about copper and crude oil, that the trend is up. Don't fight it. We're going to find them higher. Right now, we are positioned. We've recommended for clients to have broken wing butterfly call spreads in copper to give us upside exposure. Really sort of trying to pen it at 365, but if this thing really takes off, so the strategy there is a 360, 365. 368 butterfly call spread that we've been in, and that broken wing, if this thing just really took off, we're at least going to make a penny on that, and that's sort of the way we bought in for a penny, and that way, if we see this thing just really keep going, we're going to make some money on it. It's one of those contracts that can be tough for people at times because it does have big overnight swings, it does have early morning swings, and it's a large contract. There isn't really a lot of liquidity in the minis for other traders that try and learn on it per se. But I think there's a good floor that's developing here, 340, 350, and again, it's become something that really dependent on the U.S. dollar. And one thing that people don't really look at is the Chinese yuan relative to the U.S. dollar, because it's not a tradable contract. But 1.156 is a level that we're looking at in the yuan over the dollar that's going to be a trend line going back quite a few years. And that could bring some near-term headwind. So I'm watching copper as that Chinese yuan strengthens against the dollar into that resistance level.
All right, China actually reported a slightly larger than expected rise in December reserves this morning, or overnight, I should say. Reserves rose by 38 billion in December, so the yuan is certainly something to keep an eye on. That was actually following a 50.5 billion increase in November. Now, I want to move on here from metals on over into another, commodities. I want to stick with them, but focus on grains, because I'd imagine if you're talking China demand, if you're talking a weaker dollar, again, this just fits right into the whole discussion again in many ways. Can you talk to us about the bid that's been playing out in the beans, corn, wheat? Is this preemptive, or is this something that we can see in terms of precursor to inflationary pressures on the rise in the coming weeks, months, and in the new year?
Listen, I think there's some really interesting things going on in the agriculture markets, and more than half of our business on the clearing side is working with farmers and hedgers, farmers and ranchers who are hedging out there. And we put a lot of great information out there. My partner Oliver Slope does a lot in the ags, put a lot of research out in the mornings. One of the things that I think that we really could see with the beans sort of decouple from what we've seen or what we see in the corn and the wheat. Beans could really run here, and one of the things I think, going back to China, you mentioned China. China they're hoarding agricultures. Mm-hmm. Part of their 5-year plan that begins this year is hoarding agricultures as well as metals. And we've seen this, and the weaker U.S. dollar is providing them a tailwind for this. There really is sort of an economic war, an economic Cold War taking place that no one is acknowledging right now. And I think China right now is behind a lot of this that we're seeing in the metals, and we're seeing the agricultures. Now, specifically for trading soybeans, $14 to $14.25. There is some good resistance long term relative to charts that we've seen on there. But if this trend continues, listen, I would not be surprised to see beans near $20 before the year is all said and done. Which is a new high. I think there's definitely some interesting components at work here right now.